Hey traders, BA here with another short video titled How to Select the Correct Call Option by Using Deltas. Alright, so today we're going to discuss what the option delta is, what our delta wheelhouse is in our program, why we use what we use, and then of course I'll always make sure you're focused on liquidity in the options market. Alright, so what is option delta? Well, all options have a pricing mechanism, and delta is the first derivative of that. Call option deltas range between 0 and 1. So call option deltas are always positive. Delta is just the ratio of comparing the price change of an asset or a stock to the corresponding change in the price of its option. So as an example, we're going to use Big Corp. It's a publicly traded corporation. Of course, its shares are traded across the exchange, and it's big enough to where it has options. So we're going to go in and buy. We're bullish on Big Corp, and we want to buy a call option. For the sake of this example, the delta for the call option that we're buying is 35. So that means, again, just keep in mind that the delta is 35. So you guys hear me talk about I'm buying the 90 delta. Well, this case, this example, we're buying the 35 delta option, which is out of the money. That means a $1 change in the price of Big Corp stocks generates a 35-cent change in the price of Big Corp call options. So again, in this example, if Big Corp's shares trading at $20 and the call option trades at $2, so $2 would be the ask. That would be what we were trying to buy the call option at. So if we get it for $2 and the shares of Big Corp move up by $1, then the change in the price of Big Corp's shares by $1 will increase the price of the option from $2 to $2.35. So you can read through that, sort through it. Source for this is Investopedia. I have a lot of really good basic things in there, so you can pull this up and get a little more refreshed with it. All right, so that's the basics behind the call option delta. We use delta for other things as well. We'll cover those in future classes. Now let's stroll through and go through an example here. Let's say that real life example, we have QCOM that we're taking a look at. Our wheelhouse when we buy call options is somewhere close to the 90 delta. The reason I like 90 delta is because of the definition you received. You know, a dollar move means that call option I'm buying is moving up roughly 90 cents for every dollar that the stock price moves up. So we happen to think that our technique, our method of entry, is right more than 50% of the time, which it is, and it's also right very quickly. So, you know, in less than 2 weeks. So based on that, I want to use as high a delta as I can when I'm buying the calls. Same goes for the puts, but that's another class. So I always try to go somewhere close to the 90 delta. A lot of times it works out to be the 70 or the 80 because of the way the options chains are. But that's why I want that punch because of our method, the way we trade. So let's go through a step-by-step example. Let's say we're interested in QCOM. We want to buy calls. We're bullish on Qualcomm, so we think it's going higher. My method is signal at entry, and we want to get in. We think we're going to be in the trade less than 2 weeks. So what I want to do is I'm going to analyze the trade first. So I go over to my Analyze tab, click on Add Simulated Trades. Let me close the options chain up here. So, you know, we think we're going to be right within 2 weeks. So you could select the options chain either 15 to 22 days out. It doesn't really matter, either one. For this example, I'm going to use the 19 Jan 18, which is 15 days from now. That's what the parentheses mean. Alright, we've got the option chain open. This is the call side. So in your layout, you want to make sure that you've got your all strikes selected up here, and you can also manipulate your layout. So if you wanted to see, for example, just volume and open interest, just change it. That'll give you volume and open interest. If you want to see all of the Greeks, delta, gamma, theta, vega, you can pop those up right there. So you can change this ever how you want to. You can create your own and customize it. You know, I have one here that I refer to when I was selling options all the time. But we'll go back to the Greeks. So we have delta over here on the call side. Now we notice up here that the ask is trading at 66.18. Currently this is pre-market, so the options market hasn't had a chance to shift in this just yet. But we're going to see the 66 line is going to be the at the money option. All right, you'll notice over here that's the 49 delta. So the 50 deltas, somewhere in that range, that's always your at the money options. Excuse me. All right, so we want as close to the 90 delta as possible. I do. So I go up, I find the 86 delta, come across, and I'm going to be trying to buy that 86 delta call option right there. I've got it queued up. Next step is I want to go over to my risk profile and just take a look at it. All right, so I see that for every one call option I buy, I've got $375 of max risk. That's if Qualcomm goes to zero, that's what I lose, $375. And if we get the move that we're looking for, and we think that we're going to get a $2 pop or more, then we can look up here and see that, you know, at 68 bucks, you know, we've got roughly $173 profit. So, you know, roughly 50%. Our wheelhouse, again, we're shooting for 25 to 100% return in our program as quick as we can get those. So anyway, that all looks really good. Now all we have to do is queue it up and actually trade it. So we've, if we're during the market hours, I'm gonna again, we're in the Analyze tab. We started out in Add Simulated Trades. Now we're in the Risk Profile graph. If I want to buy this option during market hours, then I can click in here and confirm and send. I'm going to drag this up. Now what I want to do is edit it. Again, I want to reinforce this. If we're trying to buy this today, then we'll leave this set today. If you want this set for until it triggers, then you can change that to good to cancel. But we're going to just leave it set for today because we want to try to get in today. We never ever buy on the right hand side of this graph. They'll trade with you all day long and take your money. We want to try to buy as close to the mid 365 or lower. I always try to get in a little bit lower, so I'll set for 355 and you know, 2 ticks below the mid, and then confirm and send. Now you've got one last chance to make sure that this is right. You've got your commissions and everything set. If it looks good, then go ahead and send the trade. We're not going to do that now, but that's step by step on how to do it. If you can't get in because I'm using price discovery, I'm trying to trade below, and Qualcomm is firming up, then you'll just have to go back in and cancel and replace your trade and move it up to get closer to the mid price of where the market is. Alright, I hope that helped in this little short video series. Always, again, make sure your options are liquid, meaning making sure that the difference between the bid-ask is as tight as possible. These will tighten up during the day. This is after hours or pre-market, so they're a little bit wider. But during market hours, you never ever want to see, especially on a $65 stock, you know, 50, 60, 75 cents difference between the bid-ask spread. That's just way too much. Okay, that's it for this quick little video. Hope this helps. This is BA signing out.